Hey everyone, and welcome. Today, we're going to dive into a tool that honestly could completely change how you look at market trends. It's called the Exponentially Weighted Moving Average, or, a lot easier to say, the EWMA. So let me ask you a question. Have you ever been staring at your charts and you see this huge price move, but your indicator only tells you about it after the fact? It's so frustrating, right? Well, that feeling, it usually boils down to just one big problem. And yeah, that problem is lag. You see, most of the standard indicators we use have this built-in delay just because of how they're calculated. And in a market that's moving by the minute or even by the second, that delay can be, well, it can be really, really costly. Think about it. On one side, you've got the market reality. It's fast, it's wild, it's totally unpredictable. And on the other side, you've got your standard tool, the simple moving average, which is just slow. It's lagging, it's always delayed. Seriously, it's like trying to chase a Formula One car on a tricycle. You're just never going to catch up. And here's the real kicker, the fundamental flaw with the simple moving average. It treats every single piece of data the same. The price from 30 days ago gets the exact same vote as the price from yesterday. And that right there, that is what creates that painful, frustrating delay. But what if there was a better way? A tool that was actually designed from the ground up to fix this problem of lag? Well, good news. There is. So let's meet the EWMA. The exponentially weighted moving average, it pretty much does exactly what the name suggests. It's a moving average, sure, but it gives way more weight, exponentially more, to the most recent prices. And that's what makes it so much more responsive to what's happening in the market right now. Here's a really easy way to think about it. The EWMA is basically a moving average that just has a much, much better short-term memory. It remembers what happened yesterday way more clearly than what happened last month, and that lets it adapt super quickly when the market decides to change direction on a dime. Okay, so how does it do that? What's the secret sauce that makes the EWMA so much quicker on the draw? Let's peel back the curtain and see how this thing actually works. I love this slide because it gets right to the heart of it. The SMA, it's democratic, right? Every single day gets an equal vote. But the EWMA, it's more like a meritocracy. The most recent days get the most say because, let's be honest, they're the most relevant to what's happening now. And this chart right here, it just nails the concept visually. What we're looking at is how much weight each tool gives to the very latest piece of data. See that tall bar for the EWMA? That shows it cares a ton about what happened today. Now, look over at the SMA bar. It's so small. Why? Because today's price is just getting lost in the crowd of all the other days. And that huge difference in weight, that right there is the secret to why the EWMA is so much faster. So this whole weighting system is controlled by this one really important knob you can turn, called the smoothing factor. By tweaking this number between 0 and 1, you can decide exactly how sensitive you want the EWMA to be. A higher value makes it react faster, great for short-term trading, while a lower value gives you a smoother line, which might be better for spotting those longer-term trends. Now, I know what you're thinking. Oh no, math. But hang on, let's just quickly walk through a super simple calculation. You'll see exactly how this whole idea of weighting recent data works with actual numbers. I promise, it's way more intuitive than it sounds. All right, let's follow the numbers. Day 1, price is $100. So our EWMA is $100. Simple. Now, day 2, the price jumps to 102. The new EWMA kind of blends that new price with the old one, and we land at 100.40. You can see the pattern, right? Every new day, especially that big jump to 105 on day 4, the EWMA gets pulled strongly toward the new price. It's this constant moving blend of new info and recent history. Okay, so the theory is cool, but where does the EWMA really earn its stripes? Let's jump into a real-world example, one that involves some pretty extreme volatility. Remember early 2021? The whole GameStop saga? I mean, that was one of the wildest things we've seen in the market, ever. At one point, the stock literally plummeted 40% in just 25 minutes. Think about that. That is exactly the kind of situation where a slow, lagging indicator isn't just unhelpful, it's a complete disaster. And the amount of money on the line in moments like these is just staggering. During just one of those rallies, short sellers lost an estimated $1 billion in a single day. When a market moves that fast, having a tool that can keep up isn't a nice to have, it's absolutely critical for survival. And that's really the point here. In a crazy situation like GameStop, just picture the two lines on a chart. The SMA would be chugging along way behind the real price, but the EWMA, it would have started to hook up or down much, much sooner, staying closer to the action and, just maybe, giving you that crucial early hint that a massive change was happening. But hey, let's be real. No tool is a silver bullet. The EWMA's greatest strength is actually tied to its biggest weakness. So to give you the full story, we have to look at both its benefits and its blind spots. So on the plus side, it's super responsive, and it does a pretty good job of smoothing out the meaningless little jitters in price. But on the downside, that exact same responsiveness can sometimes trick you, creating false signals in a choppy sideways market. And let's not forget, while it is faster than an SMA, it's still looking backward, so there's always going to be some lag. So here's the bottom line on the risk. You have to be careful. The EWMA is so sensitive that it can sometimes scream new trend just because of a quick random price spike that goes nowhere. That risk of overreacting, that's the price you pay for speed. All right, let's wrap this all up. What are the big things to remember? 1. The EWMA is faster than the SMA, period, because it cares more about recent prices. 2. That speed is a huge advantage in wild, fast markets where things change in a flash. And 3, and this is so important, it's a powerful tool, but you should never, ever use it all by itself. Always use it with other indicators to get the full picture. And that really leaves us with one final big question to chew on. The EWMA, for sure, gives you a faster signal. But that makes you wonder, doesn't it? Is a faster signal always a better signal? That's the core trade-off, right? Speed versus noise. Something every trader has to think about. Thanks so much for tuning in.